Hello again and welcome back for another edition of London Direct. There's been some interesting data released around the UK economy. There's been the Bank of England minutes, which I'm stood next to right now. There's also been CPI data and also the latest jobless rate. To analyse all of this, I've been speaking to Ranko Berich from Monex. Let's start with that jobs data. Some real good news there in terms of wage growth.
Yeah, absolutely. So that was the strongest real wage growth that we've seen since well before the recession. And I think the most interesting implication of it is really it now opens up the potential for less fence sitting from the Bank of England.
Yeah, in terms of those Bank of England minutes, I was reading through them with interest. They explicitly said that their monetary policy was not going to be influenced by other central banks. And you would think that the Bank of England would be reluctant to put up rates before the Fed.
Yes, absolutely. And I think regardless of the Bank of England's assertion that its monetary policy is independent, of course it's going to say that, and in effect it is independent, but the moves of other central banks affect the factors that the Bank of England will make its decisions on.
And what does this all mean for the inflation picture? Also interesting from those bank minutes was that it seems that households have been saving that cash that they got from cheaper energy prices.
Right, that's right. So, and it's not just from the cheaper energy prices. We have seen households, and this was what we needed. We have seen, to an extent, a certain amount of deleveraging in UK households, and we haven't seen until recently. And this is very interesting. Until really the last few retail sales prints, we haven't seen sort of the large uptick in consumer spending that would indicate that households are starting to become a little looser in terms of how willing they are to consume. But what we're seeing now is we've seen actually recently strong retail sales, and I know that may have been seasonally affected, and again we've seen strong earnings growth. So you put those two things together and potentially you do have the makings of proper consumer-driven upwards price pressure. And the implication of that for the Bank of England is that when they look at the way sort of risks to inflation are weighted, now the upside risks are actually starting to look a whole lot more tangible than they were even, say, a month ago.
Yeah, well, obviously the Bank of England has its inflation targets. In terms of when it times its next rate rise, obviously we're at a very low level at the moment, and the target is 2%, but how close do you think the bank needs to be to 2% to start thinking about realistically raising rates?
I think the bank's not looking at the headline inflation rate. So essentially what they're looking at is the outlook for inflation. So even, I think, if inflation starts to head up very quickly, for example, if we see fuel prices normalise or something like that, I think the bank will still look at the underlying dynamics of inflation. And again, that's one of the things that was so interesting about today's average earnings figures, that if there is evidence that slack is running out in the economy and the labour market in particular is starting to grow very tight, then that actually starts to create quite a powerful case for the Bank of England to look at normalising monetary policy.
So if we look forward and try to predict what's in the next set of Bank of England minutes, I know it's difficult, but what do you think is going to be the big change from the MPC?
I think the big change will be there'll be much more of acknowledgement of upside risk, and we do know that there's at least one or two members in the MPC that do lean on the hawkish side and are of the view that slack is running out in the labour market, and potentially, do you know what, I think within the next quarter, maybe 2 quarters, maybe even the next meeting, we'll start to see those hawkish views be expressed in the votes.
Yeah, but before we look at currency implications, we have to talk about Greece. One of the things I've liked coming here to speak to you is that you've always had a strong opinion about Greece is staying in the euro, but things are starting to waver there, it seems.
Yeah, absolutely. So we've reached, when you're telling a good story, you have to have a dark moment where things look worse before the resolution. But at the moment, we don't know if there's going to be a resolution. We've had a particularly confrontational speech from Tsipras this week, where really he's shown that, at least at first glance, there's no intention from Syriza to cave, as some people are expecting them to. So really now we've reached the point where negotiations aren't even happening. We've had the lines drawn in the sand, and I think Greece has to decide how committed it is to delivering reforms, and Europe has to decide how important the European project as a whole is, because I think it's very easy to say, look, Greece has more to lose in this equation. We absolutely know that Greece has a lot to lose, but actually Europe as a community also has a lot to lose in terms of credibility, and in terms of if Greece was laid out to dry, I think it would really expose the fundamental flaws of the Eurozone.
Yeah, so let's finish by looking looking at those rates, we were discussing off camera about the euro, how it's actually relatively robust, or not robust as such, but it's not moving, not very volatile, considering we could be facing a Grexit. Why do you think that is? And if we do get a Grexit, how low do you think that euro will go?
I would call it headline fatigue. So essentially we've had months of really non-firm reports. So, negotiations going well, negotiations aren't going well, and really that's all we're seeing now. So I think as a result of that, the risk of both resolution and a complete breakdown have been more or less priced into the range that we're seeing in euro-dollar at the moment. To see a break outside of that range, we'll need to see a firm, like a very high probability that Greece is going to default, or a resolution. Now, to answer your original question, where would euro-dollar go? I mean, my immediate target would be sort of below 107, and perhaps even eyeing the lows from earlier in the year.
Yeah, and let's finish with looking at sterling as well. It's interesting, especially if we think about cable. You've got two relatively strong economies compared to what we see elsewhere worldwide. So what do you think cable will look like, and also that euro-pound rate as well?
I think in terms of cable, I think what markets are really looking for is a confirmation of the FOMC's intentions. So we have had sort of slightly conflicting data from the United States. Manufacturing and export-orientated parts of the economy are being weighed down by the stronger dollar. However, the rest of the economy, particularly the jobs market, is performing quite well. So markets need some confirmation as to how the Fed weighs those different factors. And after that, I think dollar upside could potentially be back on the table.
Thanks to Ranko for his take on everything from UK to Greece. Stay tuned for more of the same, but for now, goodbye.